Hi traders, good morning, good afternoon, good evening. I hope all of you are doing good. So what's special about today's video? In today's video, we are going to relate the open interest data uh, versus the price action. So we will combine both open interest and we will see how it can help us identify the trend of the market by combining both open interest and price action. So we are going to use some paid tool. You can also do it by tracking the option chains data, which is available free of cost, or you can link up to an Excel to do that. And we will also touch upon the point that why it is important that you should always maintain 1:3 ratio. 1:3 ratio will only ensure that you are profitable in your trading in throughout if you take an average for all the trades what you do. And you have to be very specific, follow these kind of strategies which I teach you on options in my channel, because this will give you a clear risk to reward ratio. So without wasting further time, let's get started on the charts, and this session is going to be really exciting for you. Stay tuned. So here we are on Bank Nifty chart. Today what we'll do is we will try to look at the candlestick patterns and try to understand how we can compare this price action with open interest data. So that is something new which I'm going to teach you. So for that I have multiple resources, like I use my own Excel sheet which gets updated along with the live market, but there is also a good paid tool which is available, which is option iCharts. Okay, so iCharts will give you actually this data at a very minimum cost. You can take an annual subscription for this and try to decode the market. So what are we going to do now? Today I will show you Bank Nifty. This is a daily chart, and let us do it for the month of January. So let's start from 1st Jan. So this is a candlestick pattern. You can see this is a consolidation zone where the market was, and the price was not moving away from this zone. Later it started moving away. So now we will analyze 1st Jan. So let's see what was the open interest from 1st of Jan for us to decode the market. So here I have selected Bank Nifty 28th Jan expiry, which is a monthly expiry, and let's choose a 1st Jan, which was a Friday. So when I click on historical 28th Jan 1st, so this data is available most of the sites, but this data is important for us. And here I'm only looking at near ATM strikes, not all strikes. All strikes will give you a biased view because that the volume will be very high. So here at the money strikes will actually give you a proper direction of the market if you are able to decode. So here we can see high puts, total puts are high, total calls are high. So we are considering this data as call writing or put writing data, because the maximum writing happens by the people who have big money. Small retailers will not be able to add so much of writing volume. It is obviously written by big institutions or hedge funds or big traders, FIIs, that they are doing this. Okay, so here we assume that total puts have been written, which are high. So when we say put writing is high, then what will be the direction of the market? Let me tell you. Okay, when put writing is happening, the direction of the market will be upwards. That means they are writing puts at this level. So this will act as a support for them. So they are expecting market not to go below this level, and they are writing heavily here. So they are expecting the market will not touch this level, so it can stay in this range. So this is the logic. So we are expecting upward movement in the market looking at this data. Okay, so now let's correlate this data with our price chart. So this was of first, so then we need to look at what happened on the second. So this was the 1st Jan, and second, as you see, initial movement, it came down first. Okay, and all of the retail traders must have thought the market will come down from here, but since we know that there is a high put writing, and we also track the open interest on a real-time basis on this candle also, we'll get to know that the put writing is still continuing to go higher, so that the reversal came and the market moved up from this. Okay, so assume that you are not able to decode this day, and this day ended up in a sideways day. Wherever it has opened, it has closed there, or it was a neutral day for you. So let's see what was the open interest on 4th of Jan. To identify 5th of Jan direction. So this was on 4th of Jan, which was a Monday. So here 4th of Jan also open interest was high on put side. So the first view what you are having is buy side, and that too market is moving up, so you are having a bullish view, right? Looking at this data. Second thing is you will go and analyze the chart as the market opens on 5th and see how it is behaving in the first hour. So 5th Jan the market opened lower, but it never touched the open price. From there it started moving up, and the moment it has taken out this high, then definitely lot of buying will start coming, because a lot of big players trade on this range breakout strategy, and once the range is broken, a lot of buying will come and a lot of volume will come, so it will start going up. So from here it went up. So this was definitely a long signal for you, and if you have followed the open interest, you would have made money on this candle. Now let's look at 5th Jan open interest. What was it saying about 6th Jan? So 5th Jan closure open interest, again it was showing there is heavy put writing only, there's no change. Call writing actually gone down, so the same thing will reflect in open interest. See, the market opened here above and it went up from here. Now let's look at 6th Jan open interest. 6th Jan open interest, still bullish, market is still writing puts, so the price also moved much higher. It went up, but it closed little lower than the open. So this was also a neutral day, but if you are carrying a position, you could have definitely made money because it has gone up. In intraday, if you are following the open interest, then it would have been a neutral day for you, because only puts were heavy. It wouldn't have changed much for you. Then let's look at 7th January open interest. So 7th January open interest was again a bullish. So more puts are being written. Okay, so here also we can see market actually opened here and it dropped from there, but it never went previous days below the previous day's close. So market again closed on a bullish note. This is showing as a bullish sign for us. So let's look at 8th Jan to predict for tomorrow's movement, that is 11th Jan. So 8th Jan, open interest was also high on the puts. Okay, as you can see, 32,000 put is high, and the calls were written for 33,000, and 31,500 put is also high. So near at the money strikes, put writing is heavy. So still there is a upward movement which is possible in the markets. So this way we are expecting the market can go higher from here. Okay, so this could be possible looking at the open interest data. I would have been bearish if this low would have been broken by this candle, but this low was not broken and the candle closed above it. So let's analyze this candlestick pattern on a 15-minute time frame for that day. So in a 15-minute time frame, market was exactly flat and it was in the same zone where it has opened. So nothing much happened, but trend looks definitely upwards. So let's see by drawing a ray from here. This was your trend line. Your trend line is broken. Either the market can open gap up or it can open gap down to come down to this level. But looking at this open interest, I am getting confidence that it might again go up from here. Now look at this from a slightly lower time frame. Let's see on a 3-minute chart. 3-minute chart was very volatile that day. As you can see, how many times the super trend crossed? Once, twice, thrice, 4, 5 times it crossed. Whenever there is a crossover happening more than 1 to 3 times in a day, expect the market to be sideways. That's how I look at it. If you have noticed, the price was going below VWAP, selling was above VWAP, below VWAP, above VWAP, below VWAP, above VWAP. And also there was a central pivot range rejection. The first candle, if you are a CPR trader, and this was our setup, this has taken a retracement from CPR and the high was crossed, you could have gone long and you could have made money till here. Okay, the second time again it came to the first support. From there it has gone till here. Third time was very small, one candle. Later, if you have taken a trade here in the same fashion, but there was no indication because this high was not taken, so this would have been a wrong trade. Here it has broken the CPR, and if you have gone short here, you would have made loss because the market jumped back from here. I would definitely wait for this high to be broken. Once this high is broken, you can take long, but even that was not fruitful because it would have not hit the stop loss would have been here, but you have to take a very low quantity, and then it could have gone up. Then it took support again here, and again there was a support at central pivot range. So central pivot range is actually a very good strong support. You can blindly follow this rule that if you get a candle on the central pivot range and a green candle taking out the high of the central pivot range, you can definitely have a good quantity with a stop loss below this. So 5 to 10 points you can easily grab, and if you have patience and holding capacity, you can hold it for this long ride. There are days when it takes off from here like this, so those days will be very fruitful, and there are days when, see, timing is very important in the market. So whatever patterns you see before 11:30 or maximum by 11, that is where you have to go for these kind of trades. If you try and take trade after 11:30 till about 1 o'clock, then you will end up in making losses, because here there will not be much of a movement. It will be always be like this, sideways, and then this trend, whatever trend was in the initial hour, that trend will continue in the second half, because institutions and all, the first hour will be very important for them. They trade here, and after that they take a break, finish their lunch, and then they come back again to continue their buying or selling for the day. So always think like that, and if you try and take trades here, it should be always selling trades in this. You should do option writing in this period, mostly till 1 o'clock. And if you are profitable by taking a option writing position till here, cut the position before 1, because usually at 1 there is a big move which is going to come. From this point till this point there will be big move, so expect that. You can analyze this in the previous days also. Like here 1 o'clock market moved up from here, and after that at 1:32 again it came down. So here where was the fall? This started from 1 o'clock. See, the fall started from 1 o'clock, it came down till 2:12, it came down from there, starting 1, and then it moved up. So you will be able to see these patterns. Let me show you a good example. I want to show you a good trending day where you can see the movement starts from what time. So let's look at that. It should be there on this day. Yeah, so this is a pretty decent day. See this day. This was around 1 o'clock. This was the at, even if you have taken a CPR support or a VWAP support, you can say it came close till here. After the green candle formed, so this will be your entry point, and after that you see how the market has gone up. You could have taken super trend as your trailing stop loss, and you could have gone with the trend. So it started at around 1 o'clock at this time, and then it continued to move up. This period it was sideways, as you can see. What was the moment initially on the open? See, there was a open down. This was a pattern. It moved up. It moved up till 11 o'clock. From 11 till 1 o'clock, it was in sideways, and after that, it started moving up. So this is how you have to make your observations in the market and play according to it. You cannot be wanting to trade with one setup at all the time, and location is very important. Timing is also very important for us. So this is how you have to analyze in whatever stock you trade or whatever index. Even if you're trading in Nifty, you have to correlate all the points, take the price, take your setups, and look at the locations and look at the timing. If you are a buyer, option buyer, timing is very crucial for you. You have to be always at the right spot at the right time. You can't do option buying in this period around 11 to 1, because you are going to lose the money which you make here, because this will be completely sideways zones. Only on very few days you will get movement in this time period, which can be very high volatile days. And after 1 you should always wait for a big movement. It can happen. So I hope this video must have helped you in terms of breaking down the points, analyzing, and linking up the open interest data. You can also look at futures open interest build up in this tool, which is you can actually see the real-time breakup of open interest building up. Like every 5 minutes you can see, or every 60 minutes you can see what is the direction of the market. So if there is more of short build up and add the volume, then you can say that it is going to be a bearish market. If it is more of long build up with high volume, then you can say definitely the market is going to be bullish. So always look at the open interest. For intraday, you should always take the benchmark of the open interest by 11:30. That will give you a clear direction of the market for that day. Okay, so the data which I'm sharing, guys, is very confidential, and most of the people charge a bomb to share you this information. So I hope you give me good number of likes and comments on this video, and we expect to continue give you this kind of content and knowledge going forward. So I am mostly trading in option strategies, which I continue to do. So my schedule is such that I don't keep looking at the market all the time. So I mostly create a strategy decoding all the data. If I am right, I will make a profit. If I am wrong, I'll make a small loss. So my risk to reward is always like 1:3, 1:4 in option strategies, which you have seen in the past videos. So I hope you also follow the same path, and it is not difficult, because if you follow this kind of strategy and path, your mental stress will not increase. Because I see a lot of traders trying to catch the every move, they get so stressed and they don't have a proper trading plan. So your trading plan, whatever you define, whether it is an option or a stop loss strategy or a particular setup breakout strategy, always have a plan and stick to that plan, and don't try to change the plan as the market changes. So you have to maintain that thing and always have the risks to reward higher. You have to lose 1 rupee and always make 3 rupees. Only then you will be profitable, because there are other charges which you are paying in the market. So if you make a loss also, you pay commission and brokerage. If you make a profit also, you pay commission and brokerage. So your profit should be higher, so that it can compensate your loss plus the brokerage and commissions. So this is a key factor. So that's the reason you should always attempt for a 1:3, 1:4 kind of trades. That is only possible if you are following option strategies, because in that you are 100% sure that wherever the market goes, you will always lose the amount which is defined for you, and always gain the amount which is defined for you in that strategy. So this is the best way which I can tell you to trade. So please do follow my channel and subscribe, so that you can get these kind of informative videos every week. Thank you so much for watching. Have a great day.